Price creates a perfect level of a demand zone. Everything lines up perfectly, gives a nice reaction for you to enter on the close here. You go for your usual 1 to 2 or 1 to 3 risk to reward, but then what happens is price literally breaks the hell out of your take profit and runs for a way bigger move than you could ever expect. So if you want to increase your risk to reward without lowering your win rate, then you have found the perfect video. I'm going to teach you exactly that, and let's get into this video. So this will be exactly what you'll learn inside this video. First, you got identified trend shifts, which comes with, key levels and all that. I'm going to explain that right now. Then I got aggressive entries. I'm going to explain how to actually enter earlier, flip entries, break off candle entries, and a directional close entries. And then the most important one, number 3, is where to actually target. Like, you can't actually increase your risk to reward if you don't know what to target. And also, by the end of this video, I have made a quiz so you can actually test your knowledge on what you have learned inside this video. So make sure you focus. So for the number 1 is identify trend shifts. Now I have a setup right here. Now obviously it would be a trade I would take if I just look at the 30-minute time frame. As you can see, we just took out the recent highs just into all this beautiful clear space on the left here, and also we have a decent level of retracements. Now what are trend shifts? If I go on a higher time frame like the 4-hour and I zoom out and I see where we reacted from, as you can see, we came all the way up here from a bullish trend and then we started moving bearish from that. So what I'll do is I'll put this line just here and I see if we have previously reacted from that same place. And if I zoom out, you can see we have reacted previously here, major highs over here, this small high here. We have reacted from this place so many times, and every single time we came to this line, we had a strong push down. We didn't have a push down like this, we had a push down to the bottom, like all the way down over here, as you can see. So what we can expect if price comes to this place again is price wants to come all the way back down, and what happens is exactly that. Price comes all the way back down and basically reacts from this key level. Now key areas are very important. Now if you're trading something like the 5 minutes or lower time frames, then it won't really matter. But if you want to catch those high risk reward trades, then you're going to have to understand actual trend shifts. So let me show you an example where it's actually useful. Alright, so I have a perfect example here, but before I explain that, let me actually explain the trade. So as you can see, you had a strong push up, having your demand swing creating. Now I need a level of liquidity. Now I've created a valid level of liquidity right here. All I need price to do is come back to the zone and give a reaction. Alright, so as you can see, price gave a reaction from the zone. Now what I mean by actual trend shifts. Now, even if you're not thinking about support and resistance key levels, you can already see that this trade is completely valid to take. As you can see, we just broke these major highs to the left, and also we are not coming from any key area except for this one right here. So it is a nice level to take a buy from. But as you can see, when I mark the place where we reacted from this demand zone, we have multiple taps here. 1, 2, 3, 4, and let me go on a higher time frame, see if there's any more. 1 over here. Now this is very major, and as you can see, 1 tap over here again. Well, let me see if I can find more here. I mean, this is a very strong area, so this will be a perfect place to take a buy from. And as you can see, also another example of where price wants to run for an insane risk to reward is you usually go for a 1 to 2 or 1 to 3 on a normal supply and demand trader. If you trade, I don't know, the oil exchange, you usually go for this, and they usually break the hell out of your take profit and run for way higher risk to reward. As you can see, look at that. That's just might seem crazy, but this strategy, they just run for that in like within like 2 days. So it is just very worth it. So let me show you an actual drawing example. Alright, so as you can see, I made a drawing example. It's a bit overwhelming at the moment, but let me try to explain it. So as you can see, we're obviously not bullish. The only concept we have is we actually just broke this previous high. That's not high enough of a confirmation to actually take a buy. But if I go to previous time and I mark the low, as you can see, we have just reacted twice of this level, and once we reacted from that level, we made some bullish structure. Now, if it did something like this, reacted from that level and then gave a setup like this, it's still not like strong enough of a confirmation. I need an actual bullish structure after reacting from key areas. Now, it could be a key area like that, or it could be a key area like this. Same, it's just support and resistance. And once we react from those levels, you have bullish structure like this, and then you have a liquidity sweep coming from our demand zone. And then this is how you actually catch those risk to rewards. I'm not just giving you key levels. This is actually how you catch those high risk to reward trades, because you're catching like trend shift. You're catching the bottom of the move off the trend shift. And you know, markets doesn't move in a straight line forever, but we are catching that move from the bottom area you could possibly get in from. So let's say the trend start going bullish here, and it starts going bullish from exactly our demand zone, and then this is exactly how we catch those very high risk to reward trades. So hopefully you now know how to identify trend shifts, obviously breaker structures. As you can see, breaker structure, we have multiple levels of breaker structures, so you can potentially see a trend shift. And then the most important one to see them very early is look at past levels, key areas, you know, support and resistance. And the more recent they are, the stronger they are, the more major they are, the more stronger they are. And also you need to have an actual reaction from those key areas as well. You can't just have, you know, something like this, that you have a key area like that, all right, price comes back to it, you know, breaks through it, and then yeah, this is valid as well. As you can see, price breaks through that key level, so now it means we have higher probability to go bearish. It comes back up and reacts from that, just like this, not like this, but like this from the key area. That's allowed too. So now hopefully you understand how to identify, you know, trend shifts. Now let me go to actual how to enter and get those aggressive entries. So you wouldn't want to be entering like right here and have a stop loss like right here. Then your risk to reward is never going to be enough. As you can see, even if you go that high, it's only a 1 to 4, which is still good, but it's not like those insane you want to catch. So how to actually enter like that, obviously 1 to 30 is a bit too insane, but I'm gonna show you these entry models, and hopefully you can learn insane amounts inside this video. All right, so I have 3 examples here. You can make a quick screenshot if you want to. All right, now let me go explain each one. So a directional close, each one of these examples is on a demand zone example. So on a directional close, you enter on the first bullish candle to react from your demand zone. If it reacts bearish, you would not enter, because you need a directional bullish close from your demand zone, and also your wick or your body is not allowed to go through the zone, or it's not allowed to close inside the zone. So you need to have a wick reaction. So you need to have a wick inside the zone and not a body. So I'm going to show you live examples as well, but right now I just want to actually give you the idea of how these entry models work. So a directional close is the most common one, the most simple one. You just enter on the first bullish closure. You enter on the first bullish closure to react from your demand zone, and on a supply zone example, you enter on the first bearish candle to react from your supply zone. Now, a break of previous candle is, let's say, okay, UK 100 just tapped. I'm going to check that later. I'm just going to alert. But yeah, a break of candle is when you enter on the previous candle's break. So for example, right here, you have a demand zone, all right? You had a like good reaction. As you see, this bearish candle, you would not enter yet. I mean, if this bearish candle closed bullish, you would enter on the directional close. But as you can see, after it breaks the previous candle's upper wick, you enter. So as you can see, price comes, let's say it's making this wick, all right, price comes all the way up, all the way up, all the way up, and once it breaks this previous candle's upper wick, you enter. And on a supply zone example, you would enter on the previous candle's break. Just from here, you would enter on a break of candle right here. And a flip entry is where you flip. All right, okay, that was a bit stupid, but yeah, you have a first bearish reaction, or it doesn't have to be a first bearish reaction. Let's say this candle wasn't even here. You have a opening right here. Now what price does, it comes deep enough inside the zone. It doesn't go through the zone, it just goes deep enough inside the zone, and then it starts reacting all the way, and it came all the way up here, and then it flipped bullish. Now, a flip entry is only valid if it comes deep enough in the zone or it has a deep enough of a lower or upper wick. So for example, here it came deep enough inside the zone, came all the way up and then flipped bullish. And as soon as this candle flipped bullish, you enter. And on supply zone example, as soon as it flipped bearish. Now let me show you a live example for each one of these examples. I mean, as I said before, I've got UK 100 actually just tapping the zone. Now, I wasn't expecting this like video to turn into a live trade, but as you can see, we have an accuracy zone right here, liquidity taking out its own high and giving a reaction. Now, at the moment, I don't think I'll be looking at this because UK 100 hasn't performed as well as it used to. But as you can see, I can actually analyze this trade looking at key levels, all that. So let's see, we are reacting from over here. And we also reacted from over here because we are just coming from this strong push down. So let's see if we have any reactions. So on the zone, we have a reaction right here. And on the off the bottom of this move, we have many reactions, as you can see right here, right here. Let me see the 4 hour. Maybe there's something major. As you can see, yeah, this has strong like reactions over here. Now on the zone, it doesn't have any reactions. Now we're also like really high up, like as you can see on the weekly time frame, we are at the highest it's ever been, basically. So yeah, it's gonna have to, I mean this is giving a crazy reaction. There's no way I'm actually going to get an entry right here as well. So this is a good example on where to leave trades as well. So for example, if I get an entry right here, it would be a good trade, obviously, because then I can go for high risk rewards. But if I'm getting a reaction all the way up there, it's just not going to be worth it. Even if I target this high, it's only going to be a 1 to 5, which is still good, but this is a very big move. So it might not be worth it, but if it closes somewhere over here, as you can see, that 1 to 5 turns into 1 to 10. So that is a big change. Also, as you can see, it came deep enough inside the zone and a flip entry would be right here. So I got 50 minutes, I got time. I'm going to look at this trade. Maybe I'll enter. Let's see on the reaction, all that. But I wasn't actually planning on explaining this live trade, but let me explain the entry models. Alright, so this is a trade I explained inside the intro. Now, right off the bat, I want to say this profit target is like pretty insane, alright? And I said I'm gonna like talk about profit targets in the end of this video, but right off the bat I can say targeting this gap fill right here was my take profit, just if you guys are wondering. So that was my take profit here. But now let me actually talk about the entry model on this trade. So as you can see, you got a nice accuracy zone here, level of liquidity, and also we are bullish. As you can see, we are just taking out highs many times. We took out pretty major high over here and some small highs over here into all this clear space, and I can also see if we are reacting from any key areas as well quickly, so you guys can see. So yeah, we got tap over here, taps over here. I mean, yeah, this is just okay. Yeah, who wouldn't want to take a buy from it? Okay, this is a really good level to take a buy from. This is an A+ setup. But now on the entry model, you would enter, as you can see, on the directional close of the first candle to react from your zone. Now let's say if this candle closed bearish, you would not enter because you need to enter on the first bullish closure of your demand zone. I'm going to show you a supply zone example too later, so you can actually completely master this. I want you to finish this video with the most information you can fill inside your brain. So as you can see, a directional close here would be just on the close right here as soon as this candle closes, and a 1 pip below the lowest wick that tapped the zone. So that's just 11 pips right here. Now you could also enter on the flip entry, but it might be a bit risky because it didn't actually make that big of a wick. As you can see, if it came like all the way down over here and then went all the way back up and then flip bullish, it would be a really good example. And I'm going to show you a really good example later on the flip entry. But as you can see, just on a directional close, just targets that gap fill, maybe have a TP1 at somewhere at the high. But to be fair, when I took this live, I was targeting this high at the first, and then once I saw the momentum, I targeted that high. As you can see, this candle was here news as well, so I basically closed somewhere about over here for 1 to 15 RR. It was really insane, I have to say. So yeah, this news was really lucky as well. I thought I'd hold through news. Usually I don't, we had so much room to, so it would be reasonable to just hold through news. And this was really good trade. And yeah, so that is a directional close. Let me now explain a flip entry. Alright, so here's an example of a flip entry. First, let me explain the trade. As you can see, you have a demand zone of the bottom of this move, as you can see right here. Then you have liquidity creating a decent level of low, then a break of structure and a fake out for normal supply and demand traders, and then it comes to my zone and gives a reaction. Now, here is a flip entry. As you can see, the reason for this is because, I believe you already noticed, it went deep enough inside the zone and made a massive wick. As soon as this candle turns green, you would enter, all right? As you can see, all this wick down over here was red, and then it came all the way back up, and as soon as you see the color green, you would enter. All right, that's the most simple way I could explain it. You have a stop loss just over here, flip entry, as you can see, and for my profit targets, I targeted really back, like all the way back over here. I targeted this high, and also I think there was some gap fill over here. I want to talk about the take profits a bit later, but that's what I targeted for this trade. And also it just ran like crazy. All right, it is a bit, you know, insane. I'm not too sure if I actually targeted this. I don't really remember. Obviously it was like October, but yeah, I think it did even hit that anyway. So it was very long. It took about 5-6 days. So yeah, it was a long time, but as you can see, it hit a take profit just like that as well. And also, as you guys can see, that we are just taking out, like, this is very, very big confirmation. We just took out this major high. We also took out this high, and this would just be a perfect trade. Now, I can also see we are coming from any key areas from down over here. A few taps, as you can see, really clean. And also, I can see we are coming from a key area from over here. Well, yeah, not really. As you can see, this is just perfect. So yeah, that's an AA plus setup. This is just as good as it gets. And that is a flip entry example. Now, let me show you the one and last entry model. I only got 3, you know. So now let me show you the break of candle entry model. All right, so a break of candle entry model is really simple as well. So here I have a supply zone example. Now, as you can see, we had a wick inside the zone and gave a perfect reaction. Now, a close entry here would just be as soon as this bearish candle closes, 1 pip stop loss, just like that, and that's how you would enter. But a break of candle would be a break of the previous candle's wick. As you can see, it made a candle like this. As you can see, let me just draw it real quickly, and just like that, the next candle opens right here, and then, well, let's just make it with the wick. As you can see, it opened right here, and then it came all the way down here, created that top wick, all right, and then came all the way back down over here. And once it breaks the previous candle's lower wick, you enter. And obviously, I forgot to mention that on flip entries and on break of candles, you don't want to enter too early inside the candle. So if on the 30-minute time frame, you would not want to enter on the first like 10 minutes of like a break of candle or a flip entry, because price can do anything at that moment. So ideally, you would want to do it on the last 50 minutes of the candle, like taking a break of candle or a, you know, flip entry. But that is a break of candle. I got many examples here as well. I have another example right here. Obviously, this was not even valid because, well, the trade is valid, but I think it reacted with news, so it wouldn't even be a trade I would take. But as you can see, I can still show you an example of a break of candle. As you can see, it broke the previous candle's lower wick. And as you can see, it could make a drastic like difference. As you can see, obviously it's news, but let's say it wasn't, you would enter on the closer and you just miss out on insane profits just by, you know, having this few entry models. And also another example right here as well. Now this is a break of candle as well, just like that. You enter on the previous candle's, you know, lower wick. It broke that, and then you enter. And I think I have another example right here as well. Now this trade did invalidate it after it gave a reaction, but it's still, actually never mind, that is a directional close, 1 pip stop loss, just like that. That's a directional close. So yeah, just back-to-back trades like that is just one of the most underrated, craziest supply and demand strategies. Now you guys know all the entry models, how to identify trend shifts. I think this video is going pretty good so far. So if you guys want to support me, then obviously subscribe, like, and if you want to join the free Discord, then that's the link in the description. But now we go into the most important thing on where to actually target. So let's say you have a trade right here. You wouldn't know where to target. You would just target 1 to 2 at the low here. But if you were more advanced trader, you could target, I don't know, this low right here, this gap fill right here, that support and resistance right there. Everything, having risk management like TP1s, TP2s. So if you want to go for a high risk reward, on psychology, if you think about it, you can't actually like hold a trade for a 1 to 10. I mean, if you're a robot, you probably can, and sometimes you can, but let's say you go for a 1 to 10 and price comes for a 1 to 9 and you're $999 up, for example, and then price just start reversing. And imagine price comes all the way down over here, doesn't tap your take profit, and this comes to your stop loss. Well, obviously that would be break even, but that is just painful. So having a TP1 could give you some extra profits on the way, but overall you won't actually end up with a 1 to 10 because obviously TP1s take, well, all that. I don't want to explain that, might get a bit too overwhelming. But as you can see, if you simply just target this low or that gap fill, I mean, even that, this trade just run out crazy. I mean, what is this? Just full bearish candles, just clean as ever. Now, let me actually explain the take profit levels. And this is one of the most important part of the video. So make sure you actually focus. All right. Now, there are so many things you can target. All right. You could target, I don't know, gap fills, key levels, another like demand zone, supply zone, and it's going to be really overwhelming. So I'm going to try to explain it in the most simple way possible for the 30-minute time frame, because on the 5-minute time frame, as you guys know, I trade the 30 minutes and the 5 minutes, but 30 minutes is obviously my main time frame, so don't get messed up by that. Like, for example, if my stop loss is about 2 pips, I would go for a 1 to 4.5. My risk to reward on the 5-minute is obviously lower, but high risk to reward trades comes from the 30-minute time frame. Like I said before, there are so many things you could target for. For example, let's take this trade. As you can see, a flip entry or a directional close. I think directional close is a bit more valid. Just a 1 pip stop loss, and as you can see, price ran out like for a crazy all the way up here. Now you obviously can't exactly target that would just be, I don't know, market wizard or something like that. But let me show you the actual good places to target for. So a few things you could target is actual gap fills, fair value gaps, you know, demand zone, supply zone. So for example, you could target this here. Now obviously I would not do this, but as you can see, if it was a higher risk reward, like I said, my minimum risk reward on the 30-minute time frame is a 1 to 3. As you can see, so this here would just be a supply zone, and it could just react from it and then hit your stop loss. Now, obviously, I'm really strict with my break-even levels as well to have maximized my win rate. So, for example, if it hits already over here, I'll be break-even anyways, like somewhere about over here or at this supply zone because it reacted from that supply zone. But a take profit for this would be actually really good because we're making really swing highs. So we can basically do the same thing we have done before. As you can see, we are making these same moves, so potentially we could target something like this high right over here for 1 to 7, or some gap fills, or sorry if my charts are a bit messy, but as you can see, or some gap fills, as you can see, for example, this gap fill, because as you guys know as well, price likes to make like historical moves again. So for example, if you have a massive, you know, gap fill all the way over here, price wants to, like, you know, do the same thing. For example, right here, you have a massive, you know, gap, as you can see, massive gap right here, and you wouldn't want to target this low over here. I would target this gap fill right over here, and as you can see, this is hit perfectly because you can't expect, you know, prices to always take out lows. Obviously, as you can see, let's say you have a, you know, profit target like this. You know, this is a major high. For example, it's a really bad example. For example, let's say you're taking a long here. Sometimes you don't want to fully target the high because prices like to like double tap highs, you know, sometimes not take out the high. So a really good target to be would be either just like this, you know, because obviously price not always takes out highs, or if your take profit is somewhere over here and you have a high all the way back over here, then if it takes out this high, it most likely will take out that higher as well. So that will be a good profit target. Or let's say you had a gap fill over here Actually, I think my explaining might be a bit overwhelming at the moment or a bit confusing, but I'm trying to explain it at the best way possible. Now, there's also TP1s, TP2s. Now, for example, let's say you have it set up like this. Let's say you have a setup all the way down over here. Now, a good target for this could be, let's say you have a all bearish candles here, and then you have that bottom bullish candle. This, I would target, firstly, a TP1 at this high. So I take 50% out from the take profit 1, and then I leave the rest 50% running for take profit 2. And my take profit 2 would either be this gap fill or that gap fill, and then I can hit insane trades. So I'll lock in some profits first before I go for those high risk reward trades. Now let me show you an actual live examples. I mean, for example, I could even do this live trade on UK 100 right now. Obviously, I did not take this trade live because I just don't like that we came so high up and a stop loss is just massive. But let's say we have actually just entered right here. Now, obviously, I wouldn't target this high. Obviously, not even take a TP1 over here. I would do this. I would target this gap fill right here without any TP1. So this will be a 1 to 4. That is really reasonable. Like, imagine you take 4 losses in a row and then you have this one trade and you hit a 1 to 4 and you cover all those losses. Now, the reason I like to, take a gap fill over here, number one is UK 100 is a bullish instrument. Obviously, it's a very bullish instrument. It always likes to move up. Second, you wouldn't be want to targeting this or this gap fill or that high, because if it wants to take out that high, it will definitely correct this move because that is a strong push down and a lot of imbalances in the market. So you would definitely want to target this gap fill all the way at the high, and not even this high over here, because it could obviously just want to correct this, and then if it wants to go bearish again, it wants to go bearish again. But a 1 to 4 right here would be absolutely clean. But now let me show you an actual clean examples. Now also, what you do not want to be doing is, for example, if you have been moving up for plenty time, market always wants to retrace, so you have to be reasonable. For example, as you can see, market is just moving up. It hasn't had any decent retracement. I mean, this is a decent retracement, this one, but it needs to have a bigger retracement before it wants to move up again. So for example, we have a setup right here. Now you wouldn't want to target for a crazy risk to reward here, because as you guys know, market doesn't always move in straight lines. It wants to have a retracement. So for example, let's say I would enter right here. A profit target for this could, I guess reasonably be that high over here, but you wouldn't want to go too high, because obviously price wants to make retracements, and exactly the reason why this trade wouldn't have gone for a crazy risk reward, because price wants to make retracements. So let's say you have a straight line like this, and then you have a setup just like that right here. Now this is not enough of a retracement. Let's say price moving up just crazy like that, and also let's say we had a retracement here before just like that. As you can see, price wants to make identical moves. So for example, if we've been moving up like this, moving down like that, and then coming up here, you would want to at least expect this kind of move before moving up again. So for example, just like that, and then moving up again. For example, let's say this here is about 70 pips. All right, 70 pips. You would want this to be at least 70 pips before it wants to move back up. You can't have just a small setup and then take the trade and wish for a high risk reward because you're thinking you're really bullish. But market always wants to make retracements, even if it's bearish, even if it's bullish, it wants to make retracements. So you have to be honest with that as well. So I think that's about it for the video. Don't click off yet, because I have an important thing you need to do in the end of this video. But let me go over a quick summary. So key levels, all right, that's how you identify trend shifts, because you want to catch the bottom of a trend shift. All right, you don't want to catch at the end, you want to catch the bottom. So for example, you want to catch moves from all the way down over here, and then you can hit those insane risk to reward trades. Then number second thing is having actually aggressive entries. You can't enter right here. As you see, that would turn a 1 to 15 to a 1 to 3. So you want to be aggressive with your entries as well. Obviously, it's a bit more riskier, but a 1 to 15, I mean, come on. That's 15 losses in a row you can cover. So that is really good as well. Second thing is All right, like I said, entry models. And then the third thing is on where to actually target. Now, I might have missed some gaps, okay, but like I said, I have a free Discord and I'm pretty active there, not gonna lie. So if you want to ask me questions, you know, where to target, is this a good target, anything, then just let me know. It's in the description. And that's about it for that. Now let's get into the quiz. I got some questions there. You're just gonna have to answer them, and also let me know down comments below on your score you got.